Let's start with a headache. A very specific, very expensive headache.
Yeah.
I want you to picture someone. Let's call her Sarah. Sarah is smart. Back in, say, 2010, right when the market was on the floor, she scraped together a down payment and bought a duplex
Good timing.
in Austin, Texas.
Oh, yeah. Great timing. Buying at the bottom. I mean, that is the dream.
Absolutely. And she's been a good landlord. She fixed the toilets, she dealt with the tenants, paid the mortgage. And now, almost 15 years later, that duplex has like quadrupled in value. She is sitting on a mountain of equity. She wants to sell it, maybe buy a small apartment complex, level up her game.
Makes sense.
She feels like a genius.
Until she calls her accountant.
Exactly. She calls her CPA all excited and says, I'm going to sell for $1 million. And the CPA goes click-clack on the calculator and says, great, Sarah. Just be prepared to write a check to the government for about 150 grand, maybe more.
Oof. The silent partner emerges.
And Sarah is floored. She's thinking, wait, that's my money. I took the risk. I fixed the roof. But the government says, congrats on the win. We'll take our cut now. It feels like a penalty for success.
It feels like friction.
It does.
And that friction is exactly why so many investors get stuck. They call it lock-in. You have this asset, it's done its job, it's appreciated, but you were terrified to sell it because the transaction cost, specifically the capital gains tax and depreciation recapture, it just decimates your buying power.
Right.
You literally cannot afford to sell and buy the next thing because you lose too much of your stack in the transfer.
But what if you didn't have to? What if Sarah could sell that duplex, take the full $1 million and roll it into that apartment complex without paying Uncle Sam a single dime? I'm not talking about evading taxes, briefcases of cash in the Caymans or anything. I'm talking about legally pausing the bill.
Then you were talking about Section 131 of the Internal Revenue Code.
The wealth shortcut.
That's what they call it.
Yeah. That is what we are unpacking today, the 1031 exchange. And look, I know tax code sounds like the cure for insomnia.
It usually is, yeah.
But this isn't a lecture on filing forms. This is a deep dive into maybe the single most powerful wealth compounding tool in the United States. We are going to talk about how the richest real estate moguls play a different game than the rest of us.
It is a different game. It's a game of velocity. It's about keeping your capital moving and growing without stopping to pay a toll every few years.
But I have to be the skeptic here for a second.
Please do.
The IRS isn't exactly known for its generosity, so if they're letting Sarah keep her money, there has to be a catch. Is this actually a gift, or is it just a golden pair of handcuffs that keeps you stuck in the real estate market forever?
That is the right question to ask. And no, it's not a gift. It's a trade-off. You get to keep your money working for you. But in exchange, you have to follow a set of rules so rigid that one wrong step, literally one day late or $1 out of place, and the whole thing just blows up.
So today, we are going to map out that minefield. We're going to walk through the death zone of deadlines, the trap of something called boot.
Which is a hilarious term.
It is a hilarious term we will get to. And the myths about swapping your vacation home.
We'll also talk about the tired landlord who wants out of the toilet fixing business but doesn't want to pay the taxes, because there are solutions for them too.
Okay, let's start at the foundation. What exactly is this thing? When we say Section 131, what are we actually defining?
At its most basic level, a Section 1031 exchange, or a like-kind exchange, allows an investor to sell a property held for business or investment and reinvest the proceeds into a new property of like kind.
Yeah.
And by doing that, they defer the capital gains tax.
I want to stop you on one word there, defer.
Yes.
Because people hear tax-free exchange and they think that the tax just, poof, vanishes.
It definitely does not vanish. Think of it like an interest-free loan from the government. Normally, when you sell, you know the tax. With a 1031, the IRS says, okay, keep that tax money, use it to buy the next building. But we are keeping a tab. We know you owe us.
You're just kicking the can down the road.
You are kicking the can down the road.
You can kick that can for a really long time.
You can kick it for decades. You could swap from property A to property B, hold B for 10 years, swap to property C, and you just keep rolling that tax bill forward, never actually paying it.
And as we'll see later, there is a very specific way to make that bill disappear entirely, but that involves, dying.
The ultimate deadline, yes.
Okay, so the concept is swapping, but I assume I can't just call up a buddy who has a warehouse and say, hey, I'll trade you my duplex for your warehouse, and we just, swap keys?
You actually could. That is how the law was originally written, a simultaneous swap. But how often does that really happen? It's almost impossible to find two people who who want each other's specific properties at the exact same time with the exact same values.
So how does it work in the real world then? Sarah sells her duplex to some guy, Bob. Bob doesn't have a building to trade, he just has cash.
This is where the modern delayed exchange comes in.
Yeah.
And this is actually a fascinating bit of legal history. It wasn't always allowed. It took a guy named T.J. Starker to fight the government to make this happen.
Starker, right. I hear people call these Starker exchanges. So who was he?
T.J. Starker was a timber investor in Oregon back in the 60s. He made a deal with a big timber corporation. He gave them his land, premium timberland,
Okay.
but they didn't have the land he wanted in return right at that moment. So they basically gave him an IOU. They said,
Yeah.
we will buy you suitable replacement property over the next few years until we match the value.
So he transferred his title, but he didn't get cash. He got a credit.
Correct. A credit on their books. And the IRS looked at this and went ballistic. They said, no, no, no. You sold your land. You accepted a promise to pay. That is a sale. You owe us the tax right now.
And Starker sued them.
He fought them all the way to the Ninth Circuit Court of Appeals. And in 1979, the court ruled in his favor. They said, essentially, that as long as he didn't touch the cash, the intent was an exchange, even if there was a delay.
Wow.
That case, Starker v. United States, it revolutionized real estate. It created the industry we have today.
So thanks to Mr. Starker, Sarah doesn't need a simultaneous swap. She can sell her duplex on Monday, put the money in a special account, and buy her new apartment complex months later.
Yes. But, and this is a massive but, after this sugar case, the IRS said, fine, you can delay, but we are not giving you forever. They imposed strictly rigid timelines.
Okay, let's get into the rules. The first hurdle is this concept of like kind. This feels like the gatekeeper. You know, if the properties aren't like kind, you can't even play the game. But what does that actually mean? If Sarah sells a residential duplex, does she have to buy another residential duplex?
This is the single biggest misconception I see. People stress out thinking they have to match the asset exactly. They think, I sold a condo, I must buy a condo.
Right. Or, I sold a warehouse, I need another industrial building.
Totally wrong. For real estate, the definition of like kind is incredibly broad. The code says properties must be of the same nature or character, but they do not have to be of the same grade or quality.
Unpack that for me. Nature versus grade.
So in the eyes of the IRS, dirt is dirt. A plot of raw, undeveloped land in Nevada is like kind to a skyscraper in Manhattan.
Seriously?
Yes, a strip mall is like kind to a dairy farm. A rental house is like kind to a doctor's office. They are all considered real property held for investment.
That is wild flexibility. So Sarah isn't stuck in residential rentals. She could sell the duplex and buy, I don't know, a gas station?
If she buys the land in the building, yes,
Oh.
absolutely. She could pivot her entire portfolio. She could move from high-maintenance residential rentals to, commercial industrial warehouses. She could move from a cold climate to a warm one.
Speaking of moving, are there geographical limits? Can she sell the Austin duplex and buy a villa in Tuscany?
She would love that, I'm sure. But no, the code is very specific here. Real property located within the United States is not like kinds to property located outside the United States.
So it's domestic only.
Generally, yeah. The 50 states and D.C., there are some nuances with the U.S. Virgin Islands and Guam, but for the most part, you cannot cross international borders. You sell in the U.S., you buy in the U.S.
Okay. So what about the stuff inside the building? Let's say Sarah is selling a furnished vacation rental. She's selling the house, sure, but she's also selling the sofas, the beds, the appliances. Does that count?
This brings us to a major change in the law. We have to talk about the Tax Cuts and Jobs Act of 2017.
TCJA.
Before 2017, you could do a 1031 exchange on personal property.
Personal property? Like what?
Heavy machinery. Delta Airlines could swap an old Boeing 747 for a new one and defer the tax. A construction company could swap a fleet of bulldozers. You could even do it with thoroughbred racehorses or patents.
Wait, really? You could 1031 exchange a racehorse.
You could, but the 2017 Act killed all of that. As of January 1st, 2018, Section 131 is restricted strictly to real property, real estate only.
So if you own a construction company today and you trade in your old excavator for a new one, that's a taxable event.
Correct. No more deferral for equipment. And that applies to the furniture in Sarah's rental, too. The house qualifies. The used sofa inside it. Technically, that is personal property. It does not qualify.
That feels like a trap. I mean, if I sell a hotel, half the value is the furniture and fixtures.
It creates a complication for sure. We'll talk about how to handle that later, but strictly speaking, personal property is out.
Oh, and here's a fun fact about the old rules, just to show you how granular the IRS gets.
Oh,
when you could exchange animals. Section 1031E explicitly stated that livestock of different sexes are not like kind.
You are joking.
I am not. You could not swap a bull for a cow.
So the IRS was basically running a gender reveal party on cattle farms. Sorry, it's a boy. Pay your taxes.
Essentially, yes. I think their logic was that they serve different functions in the business, breeding versus dairy, for example. It's moot now because livestock isn't real estate, but it just shows you, do not assume logic applies here.
Only the code applies.
Only the code.
Okay, noted. Don't swap cows. And I assume stocks and crypto are out too.
Explicitly out. You cannot swap Apple stock for Microsoft stock. You cannot swap Bitcoin for Ethereum. Section 1031 is the last great tax shelter, and it is reserved almost exclusively for real estate investors. Okay, let's go back to Sarah. She knows she can sell her duplex. She knows she wants an apartment complex. She knows she can't touch the cash. Walk us through the death zone, the timeline.
This is where most people fail. The moment Sarah closes the sale of her duplex, the minute that deed is recorded, a stopwatch starts.
Yeah.
And this stopwatch has no pause button.
Day one.
Day one.
Oh.
She now has two deadlines running concurrently. The first one is the 45-day identification period.
45 days to buy the new place?
No, not to buy. 45 days to simply tell the IRS, via her intermediary, what she might buy. She has to identify potential replacement properties in writing.
45 days seems like plenty of time.
You would think so. But let's play this out. Sarah sells on May 1st. She spends the first week just celebrating and waiting for funds to clear. Okay, now it's May 8th. She calls a broker and find me an apartment complex. The broker takes a week to send her some listings. Now it's May 15th. She tours 3 of them. 2 are garbage. 1 is good. She makes an offer.
Okay, so she's making progress.
But the seller of that good property is traveling. They don't respond for 4 days. Then they counteroffer. Sarah counters back.
Yeah.
Suddenly it's June. She's 30 days in. If this deal falls apart during inspection, she has 15 days left to find a backup.
And if she doesn't?
If midnight on the 45th day strikes and she hasn't locked in a list of properties, the exchange is dead. Game over. Pay the taxes.
Can she get an extension? What if she gets the flu? What if the 45th day is a Sunday?
No. And no. The IRS is brutal. If the deadline falls on a Sunday, you better act by Friday. If you get sick, too bad. The only exception is a presidentially declared disaster like a hurricane or a massive wildfire that literally destroys the area.
That is just high pressure. So she has to submit this list. Can she just list every property for sale in Austin just to be safe?
No, you can't just copy the phone book. There are 3 specific rules for identification, and you have to pick one lane.
Okay, lane number 1.
The 3-property rule. This is the most common one. You can identify up to 3 specific properties. It doesn't matter what they're worth. Sarah sold for $1 million. She could identify 3 skyscrapers worth $50 million each. As long as it's 3 or fewer, she is safe.
Simple enough. Pick your top 3 favorites. But what if she wants to buy a portfolio? What if she's selling the big duplex to buy 10 little rental houses in a cheaper market?
Then she uses lane number 2, the 200% rule.
Wow.
She can identify as many properties as she wants, 4, 10, 20, as long as the total value of everything on the list is not more than 200% of what she sold.
Okay, so she sold for $1 million. She can list 20 houses as long as the total value of those 20 houses isn't more than $2 million.
Correct. But if she lists 20 houses and they're worth $2.1 million, she has violated the rule. And now she falls into lane number 3, which I call the suicide mission.
That sounds promising.
The 95% rule. If you violate the first 2 rules, so you list more than 3 properties, and their value is huge, you can still save the exchange, but only if you actually acquire 95% of the total value you identified.
So if I list 10 properties worth $10 million.
You have to buy $9.5 million worth of them. You basically have to buy everything on your list. If one seller backs out, you fail. Almost nobody uses this rule intentionally.
So stick to the rule of 3.
It is the safest. But remember,
Yeah.
once that 45th day passes, you cannot change your list.
Yeah.
If Sarah identifies property A, B, and C, and on day 46 she sees property D, which is the deal of the century, she cannot buy property D tax-free.
She is handcuffed to her list.
Completely.
That is the stress of the 45 days. But then there's the second deadline, the 180 days.
Right. She has 180 days from the initial sale to actually close on the new property.
That feels like 6 months. That feels doable.
Usually it is.
Yeah.
But there's a hidden trap here, too. The rule says 180 days or are the due date of your tax return for that year, whichever is earlier.
Oh, that is sneaky.
It's so sneaky. Imagine Sarah sells her property on December 31st. Her tax return is due April 15th. That is only about 105 days away. If she doesn't know the rule and she schedules her closing for May 1st,
She blows the deadline.
she blows the deadline because the tax return deadline came first. So she has to file an extension for her taxes just to get the full 180 days. It's a paperwork trap that catches people every single year.
Okay, so we have the timeline. Sarah is sweating, but she's moving. Now let's talk about the money. Because you said earlier she can't touch it.
Correct. This is called constructive receipt. If Sarah has the right to access the funds, the IRS considers them paid. The exchange is over.
So at the closing table, when the buyer hands over the check,
Sarah cannot touch it. She cannot even see it. She needs a qualified intermediary or a QI.
who is this person? Is it her lawyer? Her accountant?
It generally cannot be her lawyer or her accountant. It has to be an independent third party whose business is facilitating exchanges. If she uses her brother or her employee, they're considered agents of hers, and the exchange is disqualified.
So she has to hire a pro.
Yes, and she has to hire them before the sale closes. This is crucial. I've seen people close the deal, get the wire into their bank account, and then call me asking, hey, can I send this to a QI now?
Too late.
No, it is too late. The toast is burnt.
So the money goes from the title company to the QI. The QI holds it in a vault, basically. And then when Sarah buys the apartment complex, the QI wires the money to that seller.
Exactly. The QI is the gatekeeper of the funds.
Now let's talk about boot. I mean, you mentioned this is the trap. So Sarah sells for $1 million. She finds a great apartment complex for $900,000. She thinks, great, I saved $100,000.
And the IRS thinks, great, that $100,000 is profit you took off the table. That is cash boot.
So she pays tax on the difference.
Yes. If she keeps $100,000 cash, she pays capital gains tax on that $100,000. The rest is deferred, but she writes a check for that portion.
That makes sense. I get the cash, I pay the tax. But there's a version of boot that feels unfair. Mortgage boot.
This is the silent killer. To defer all tax, you have to do two things. Buy equal or greater value and replace your debt.
Replace your debt. Explain that.
Let's say Sarah's duplex was sold for $1 million, but she had a $400,000 mortgage on it. When she sells, the bank gets paid off.
Right.
Now she buys the new place for $1 million. But she decides, you know what, I don't want a big mortgage. I'm just going to get a $300,000 loan.
She's being financially responsible, deleveraging.
The IRS doesn't see it that way. They see that her debt dropped from $400K to $300K. That $100,000 difference is debt relief. The IRS treats debt relief exactly the same as receiving cash.
Wait, hold on. So she didn't get a check? She just owes less money to the bank, and she has to pay taxes on that $100,000.
Yes, unless she puts in $100,000 of her own extra cash to offset it. But if she just drops the mortgage amount without adding cash, she has mortgage moot. It's taxable income.
That is baffling to the average person. I borrowed less money, so now I owe taxes.
That goes back to the theory of the exchange. You are supposed to be continuing your investment position. If you reduce your liability, you have effectively cashed out part of your obligation.
So the golden rule for Sarah is buy equal or up in price and carry equal or up in debt.
Precisely. Or bring cash to the table to fill the gap.
Let's pivot to the fun stuff. The scenarios everyone asks about at dinner parties. Can I swap my rental for a beach house?
Ah, the vacation home. Everyone wants to do this. It's an investment, I swear. I just happen to test the quality of the sand personally for 2 months a year.
Right. I'm holding a board meeting with my family and a cooler of margaritas.
The IRS wasn't born yesterday. They know this game. For years, this was a battleground. But in 2008, they issued a safe harbor. It's called Revenue Procedure 2008-16.
What does the safe harbor say?
It says, okay, we will believe it is an investment property if you follow these rules. First, you must own the property for at least 24 months. This applies to the one you're selling and the one you're buying.
Okay, 2 years. End.
During each of those 2 years, you must rent it out to a stranger, not your cousin, not your mom, at fair market value for at least 14 days per year.
So it has to be a real rental. It has to generate real income.
Yes, and here is the kicker. Your personal use cannot exceed 14 days per year or 10% of the days it is rented, whichever is greater.
So if Sarah buys a beach house in Florida with a 1031 exchange and she rents it out for 300 days a year.
She can use it for 30 days, 10%.
But if she only rents it out for 2 weeks.
I can only use it for 2 weeks, 14 days. If she stays for 3 weeks, she violates the safe harbor. It becomes a residence, not an investment. And the 1031 is disallowed.
That is strict. So you can't just buy a retirement home and leave it empty.
No. However,
Hmm.
people do play the long game. This is the moving in strategy.
Explain that.
Sarah buys the house in Florida. She follows the rules. She rents it out for 2 years. She limits her visits. Then, after 2 years, her intent changes. She decides to move in. She makes it her primary residence.
Is that legal?
Yes. You can convert a rental to a residence.
Yeah.
But, and listen closely, if she wants to sell it later and claim the primary residence tax exclusion.
That's the Section 121 exclusion. If you live in a house for 2 of the last 5 years, you get $250,000 off profit tax-free.
Right. Or $500 if you're married. But if you acquired that house through a 1031 exchange, the rules are much tighter. First, you have to hold it for fully 5 years before you can sell, not 2.
Okay, 5 years.
And second, you cannot wipe out the depreciation you took. And third, under new rules, you have to prorate the gain. You can't just say, oh, it's my home now, all the tax from the last 20 years is gone. No, the IRS will allocate the gain between the rental years and the residence years.
So there's not a magic eraser.
It used to be, but they closed that loophole. It's still a good strategy, but it's not a get-out-of-jail-free card anymore.
What about the reverse? Sarah finds the dream apartment complex, but her duplex hasn't sold yet. In a hot market, sellers won't wait for you to sell your old junk. She has to buy N and now W.
That is a reverse 1031.
How does that even work? You can't exchange something you haven't sold.
You can, but it is complex. You cannot hold title to both properties at the same time. So Sarah hires an exchange accommodation title holder, or EAT.
An EAT.
The EAT basically steps in and buys the new property for her. They hold the title in a special LLC. They park it.
So the EAT owns the apartment complex.
Yes. While Sarah frantically tries to sell her duplex. When she sells the duplex, the money goes to the QI, and the ET then transfers the apartment complex to Sarah.
It sounds expensive.
It is. The fees are higher. The legal work is denser. But if you're trying to save $200,000 in taxes, paying $5,000 or $10,000 in extra fees is worth it. But remember, the 180-day clock still applies. The ETT can only hold that property for 180 days. If Sarah can't sell her duplex in 6 months,
The deal unwinds.
the whole thing unwinds.
Now, I want to address a specific listener. Let's call him Tired Tom. Tom has been doing this for 30 years. He owns 10 rental houses. He is sick of calls about broken furnaces at 2 a.m. He wants to sell, but his basis is so low. I mean, he bought these houses in the 90s that his tax bill would be millions. He feels trapped. He wants a 1031, but he doesn't want another property to manage.
Tom is the perfect candidate for a DST, a Delaware Statutory Trust.
We touched on this in the intro, but let's go deep. What is a DST?
Imagine a massive institutional-grade property, a $100 million apartment community in Dallas, or an Amazon distribution center, or a portfolio of medical offices. Obviously, Tom can't buy that himself,
Right.
but a sponsor, a big real estate company, buys it and places it into a trust. They then slice that trust into hundreds of little pieces. Tom can sell his rental houses and buy a beneficial interest in that trust.
And the IRS accepts a piece of a trust as real estate.
Yes, that was the breakthrough. Revenue Ruling 2004-86. The IRS confirmed that owning a slice of a DST is like kind to owning a rental house.
So Tom moves his money from his headaches into this giant, professionally managed building. What does he have to do?
Nothing. He checks his mailbox. He gets a distribution check every month. No tenants, no toilets, no trash. It is purely passive.
That sounds too good to be true. Give me the skepticism. What's the catch?
The catch is control. Tom used to be the king of his rental houses. If he wanted to paint them blue, he painted them blue. If he wanted to raise rents, he raised rents. In a DST, he is a silent passenger. He has zero vote. If the manager does a bad job, Tom can't fire him.
And fees. I imagine there are fees.
The fees can be heavy. Upfront loads, management fees. You are paying for the convenience. Also, it's illiquid. You can't just sell your share on a Tuesday like a stock. You're usually locked in for 5 to 10 years until the sponsor sells the property.
So if Tom needs emergency cash, he's stuck.
He is stuck.
Yeah.
But for someone whose primary goal is deferred taxes and stop working, it is a lifesaver. It's also great for spare change.
What do you mean by that?
Let's say Sarah does her exchange. She sells for $1 million, buys for $900,000. She has that $100,000 of potential cash boot left over. She doesn't want to pay tax on it. She can put that leftover $100K into a DST.
Oh, so you can mix and match.
Exactly. It's a great filler to soak up excess equity so you don't pay tax on the scraps.
We've covered the how, the what, and the traps. Now let's talk about the why. Why go through all this torture? Why not just pay the tax and be free? The math has to be compelling.
It is the math of compounding. Let's do a simple comparison. Sarah has a $500,000 gain. If she pays the tax, let's say 20% federal capital gains, 3.8% NII tax, maybe state tax, plus depreciation recapture, she might lose 30% of that gain.
So 150 grand.
$150,000
Yeah.
gone. Poof. So she only has $350,000 of equity to reinvest. If that grows at 7% for 20 years, she ends up with a certain number. But if she keeps the full $500,000 working, that extra $150,000 is also growing at 7% for 20 years.
Yeah.
The difference isn't just the tax saved, it's the growth on the tax saved.
It's the snowball effect.
Exactly. Over a lifetime, the difference can be millions of dollars.
Yeah.
It's the difference between being comfortable and being wealthy.
But eventually, the tax man comes, right? If Sarah sells that final apartment complex when she's 80, she owes all the back taxes from every single exchange she ever did.
If she sells, yes. But if she doesn't sell,
Here it is, the swap till you drop strategy.
it's the ultimate loophole. Under current law, when you die, the cost basis of your assets gets stepped up to the fair market value at the date of your death.
Explain basis one more time for the non-accountants.
Basis is basically what you paid for the property. If you bought for $100K, your basis is $100K. If it's worth $1 million, your taxable profit is $900,000.
Okay, got it. So Sarah has been swapping for 40 years. Her basis is incredibly low because she kept carrying it forward. She might have a property worth $10 million with a basis of $500,000. If she sold the day before she died, she would owe millions in tax.
Right.
But she dies. Her heirs inherit the property. The law says, okay, the new basis for the heirs is $10 million,
The current value.
the current value. So if the heirs sell it the next day for $10 million, $10 million sale price minus $10 million basis equals zero gain, zero tax.
So all that deferred tax, decades of it, just evaporates.
Gone, wiped clean. The heirs get the full value, tax-free.
That is staggering. It effectively means capital gains tax is voluntary for real estate investors as long as they never cash out during their life.
Correct. It is a massive incentive to hold property forever.
And that leads to the provocative thought I want to end on. We've talked about how great this is for Sarah, for our investor. But what does this do to the rest of the world? If every investor is incentivized to swap till they drop, to never actually exit the market, it freezes the market. Think about it. In a normal market, prices go up, people sell, they take their cash, they buy a boat, and new inventory opens up for young families or new investors.
But Section 1031 encourages hoarding.
It does. It encourages the old guard to keep circulating properties amongst themselves. I sell my apartment to you, you sell your strip mall to me. We both defer taxes, but neither of us releases the asset to the open market in a way that creates liquidity for a newcomer.
So when you drive through your city and you see those same families owning the same blocks for 50 years.
It's not just sentimental. It's tax strategy. Section 1031 is a brilliant wealth builder, but it might also be a contributor to the inventory shortage we see in housing.
That is a heavy thought. It's a tool, but tools have consequences.
They do. But for the listener, for Sarah, for Tom, the tool is there. And if you don't use it, you are voluntarily giving away 30% of your wealth every time you trade up.
So the lesson is, use the tool, but respect the tool. Get a QI, watch the calendar, don't touch the cash. And maybe, just maybe, don't try to claim your beach house as a business trip unless you really like auditing.
And please leave the cows out of it.
Leave the cows out of it. Thanks for diving in with us. We'll see you on the next one.
Yeah.